Welcome to This Explainer. Today, we're breaking down a seriously disruptive strategy. It's called the goal gap protocol. Think of it as a way to turn late match soccer volatility into, well, a mechanical ATM for calculated profit. Seriously, if you are tired of just crossing your fingers and relying on luck, you are absolutely in the right place. Let's get into it. Here's our roadmap for today. We're going to cover stop betting, start trading, then the goal gap concept itself. We'll hit step 1, the entry criteria, followed by step 2, the exit. And finally, we'll see the protocol in action. It's a strict, rule-based manual to shift your mindset from predicting winners to trading mathematical certainties. All right, section 1, stop betting, start trading. Let's dive right into why traditional sportsbooks are basically a rigged game that severely caps your upside. So look at the stark contrast between these two worlds. On one hand, you've got traditional bookmakers. That's the old way. You're just hoping for a lucky winner, predicting final outcomes, and playing against a house that is literally mathematically designed to be you. No thanks. On the other hand, and this is where the real money is made by July 2026, you bypass the house entirely. You are exchange trading. You're trading live data, exploiting algorithmic blind spots that the market simply cannot price fast enough, and mechanizing your profits. It's a total game changer. Which brings us to section 2, the goal gap concept. To actually exploit these inefficiencies, we first need to understand the underlying theory driving this whole mechanical system. So what exactly is the goal gap? Well, it's a highly specific market inefficiency that pops up in the final 20 minutes of a soccer match. Here's what happens. Aggressive time decay pricing by the market completely contradicts the rising on-pitch expected goals or XG pressure. And here's the absolutely crucial point. We do not care about the final match outcome. Honestly, we are simply targeting the mathematical gap between those dropping odds and the rising on-pitch momentum. It's like a giant tug of war. On one side, you have time decay. The market odds are plummeting aggressively simply because the clock is ticking down. But on the other side, you have XG pressure. The actual on-pitch attacking momentum and expected goals are rapidly rising. The market literally falls asleep at the wheel here. It's completely ignoring the live data that proves an attacking team is knocking on the door. And that contradiction, that is exactly where we strike. So, how do we systematize all this? Let's move to section 3. Step 1, entry criteria. Let's break down the exact emotionless blueprint required to enter a trade safely. Okay, there are 3 strict, non-negotiable rules here. Step 1 is the XG trigger. We need a minimum live XG delta of 0.85. This means we want a massive, measurable spike in offensive threat that the market is just completely missing. Step 2 is the time window. We only look at the 70th to 80th minute. Why? Because that's when time decay is the absolute steepest, giving us the best leverage on our entry price. And step 3 is minimum liquidity. We need at least $25,000 in matched volume. This guarantees we can get our money in, and more importantly, instantly out when the market shifts. No exceptions. Now, getting in is only like 10% of the protocol. Section 4 is step 2, the exit. Mastering this exit matrix is how we actually protect the bankroll over hundreds of fixtures. Your risk management here has to be entirely binary. If the high-pressure team scores, the market odds are going to correct violently. So your required action, you hit cash out or manually lay off your position right then and there. You lock in equal profit across all outcomes. We call this greening up. But what if they don't score and the clock hits the 88th minute? You trigger a hard time decay stop loss. You calculate a 20 to 30% scratch on your stake and you take that minor loss. You never, ever wait for the final whistle. You execute mechanically. That's how you let the math play out safely. All right, now for the really fun part. Section 5, the protocol in action. Let's watch this high-octane execution happen in real time on a recent knockout fixture. Imagine tracking this sequence over just 4 frantic minutes. At the 72nd minute, we make our market entry with the score deadlocked at 0-0. By the 75th minute, boom, a goal is scored. And by the 76th minute, we exit the market and lock in 65 units of pure profit. It's incredibly fast. Let's look up the exact data driving this. So, right at that 72nd minute, the live data feed is showing us that the attacking team is applying massive pressure. They generate 4 big chances. The XG spikes all the way to 1.4, yet the scoreboard stubbornly remains at 0-0. Now, completely blinded by the ticking clock, the market offers a draw-lay price that has dropped all the way down to 1.85. The algorithm just sees time passing and blindly drops the price. But the liquidity is there, the XG is there, the time window is perfect. This triggers our exact entry protocol. We step in, risking 100 units to win 117. Then we hit the 75th minute. A massive save is forced, the pressure just keeps building, and finally, a goal is drilled in right from the edge of the box. Just 3 minutes after our entry, the on-pitch reality completely shatters the market's time decay illusion. The market absolutely panics. That draw price instantly rockets up to 6.5. And because we traded the gap, we honestly don't care who wins the game from here. We immediately execute our exit matrix and green up. We lock in 65 units of pure profit in under 4 minutes. We are completely out of the market before the opposing team even takes the kickoff. How wild is that? So, the most important takeaway from this explainer really boils down to this. Traditional betting is dead. Trading the data is the future. You aren't hoping for a lucky winner anymore. You are systematically exploiting algorithmic blind spots. It's time to mechanize your approach and start running your portfolio exactly like a high-frequency trading firm. The math just doesn't lie. So what does this all mean for you? After seeing how the system exploits blind spots in live exchange liquidity, the only question left is this. Will you keep playing a rigged game against the bookmakers, or are you ready to stop guessing outcomes and start hunting the mathematical gaps?